Think U.S. stock T+0 trading is a free lunch? It's lightning-fast settlement, but it amplifies intraday swings and can wipe out your account. This episode dissects the true price of flexibility, from order types to shorting, leverage, options, and extended hours, and the risk controls that separate survivors from blown-up accounts. When you place a market order, you're buying speed, but you pay with price certainty. The bid-ask spread is the market's liquidity toll, a visible cost on every trade. For a liquid stock like Apple, the spread might be pennies, but for a small cap or a volatile name like Tesla, it can widen to 0.5%. That means buying $10,000 worth of stock could cost you $50 more than the best ask. A limit order protects your price but risks missing the move entirely. The choice is simple: are you more afraid of overpaying or of not getting filled? In calm markets, market orders are efficient. In news-driven chaos, limit orders are your lifeline. Let's compare the two primary order types. A market order guarantees execution but not price. A limit order guarantees price but not execution. In a fast-moving market, a market order can slip significantly, while a limit order might leave you empty-handed. The trade-off is between opportunity and certainty. Professional traders often use midpoint or iceberg orders to hide intent, but for most investors, the core decision is about risk preference: pay up for immediacy or wait for a better price. T+0 trading, buying and selling the same stock on the same day, is a double-edged sword. In a cash account, funds from a sale aren't available until settlement, and using unsettled funds to buy and sell again is a violation that can freeze your account for 90 days. Only margin accounts allow unrestricted day trading, but if you execute 4 or more day trades within 5 business days and they exceed 6% of your activity, you're flagged as a pattern day trader. That requires a minimum equity of $25,000, a threshold that filters out most retail traders. Even if you meet it, frequent day trading incurs commissions, slippage, and tax costs. The real risk isn't the mechanism, it's that it encourages overtrading, turning investing into gambling. Short selling is borrowing shares to sell, hoping to buy them back cheaper. The profit or loss is the difference between the sale price and the repurchase price, multiplied by the number of shares, minus borrowing costs and any dividends owed. The formula is straightforward, but the risk profile is asymmetric. Your profit is capped at the sale price if the stock goes to zero, but your loss is theoretically unlimited if the price keeps rising. This asymmetry is why short selling demands strict stop losses and position sizing. When too many traders short a stock, a short squeeze can occur. As the price rises, short sellers rush to cover their positions, buying shares and pushing the price even higher. The 2021 GameStop episode is a textbook example. A heavily shorted stock surged as retail traders coordinated buying, forcing short sellers to capitulate at massive losses. For individual short sellers, the risks include not only unlimited losses but also the inability to borrow shares, rising borrow rates, and forced buy-ins. Position sizing and stop losses are non-negotiable. Margin trading gives you up to 2 times buying power, but it amplifies both gains and losses. The maintenance margin requirement, typically 25% in the U.S., but many brokers require 30%, is the minimum equity percentage you must maintain. If your equity falls below this, you get a margin call, forcing you to deposit more cash or sell assets. The formula for the maintenance margin ratio is simple: equity divided by total market value. But the real danger is speed. A sharp drop can trigger a margin call before you can react, and the broker may liquidate your positions at the worst possible prices. Consider a concrete example. You have $50,000 in equity and borrow $50,000 to buy $100,000 worth of stock. Initially, your equity ratio is 50%, well above the 25% requirement. If the stock falls 20%, your market value drops to $80,000, but your debt remains $50,000, leaving equity of $30,000, a ratio of 37.5%. A further 5% decline brings the ratio to 34.2%. The margin call line is hit when equity falls to $25,000, which occurs at a market value of $66,667. Many who blew up in 2022 underestimated the speed and magnitude of declines. Options are contracts that give the buyer the right, but not the obligation, to buy or sell a stock at a specific price. The buyer pays a premium, risking only that amount, while the seller receives the premium but assumes the obligation to fulfill the contract. For example, buying a call option on Apple with a strike price of $180 and a premium of $5 means your maximum loss is $5 per share, but your potential gain is unlimited if the stock soars. Conversely, the seller's loss is theoretically unlimited. Retail traders often prefer buying options for limited risk, but the odds are against them. Most options expire worthless. Professional sellers use complex hedging to manage risk. The break-even point for a call option is the strike price plus the premium paid. For a call with a strike of $180 and a premium of $5, the break-even is $185. If the stock closes above $185, you profit; below, you lose. Many buyers focus on the potential upside but forget that the stock must move beyond the break-even, not just the strike, to make money. This is why options require you to predict not only direction but also speed and volatility. The premium itself is priced by intrinsic value, time value, and implied volatility. Higher volatility makes options more expensive, increasing your cost. Pre-market and after-hours trading are available through electronic networks, but liquidity is thin, often less than 5% of normal volume. The participants are mostly institutions and hedge funds. If you see a stock jump 10% after hours on earnings, trying to buy could result in a terrible fill because the bid-ask spread can be 3% or more. A small order can move the price significantly. Moreover, after-hours prices may not reflect the next day's open, as institutions may test the waters and reverse direction. For most traders, the best use of extended hours is observation, not execution. If you must trade, use limit orders and accept that your order may not fill. All these tools, orders, T+0, shorting, margin, options, extended hours, are just tools. They amplify your decisions, both good and bad. The key is to define your risk before entering a trade. Set stop losses and position limits based on volatility and support, not arbitrary percentages. For short positions, never risk more than you can afford to lose completely. For leverage, maintain a buffer above the maintenance margin to survive worst-case scenarios. The market will test your discipline. Those who respect risk boundary survive, those who don't are eliminated. We've dissected the mechanics of U.S. stock trading, from order types to T+0, shorting, margin, options, and extended hours. Each tool offers flexibility but at a cost: slippage, margin calls, unlimited losses, and liquidity traps. The common thread is that these mechanisms amplify your decision-making, for better or worse. Before you click buy or sell, ask yourself, what order type am I using? Do I understand the settlement rules? Is my stop-loss set? How close am I to a margin call? What is my maximum loss on this option? If you can answer these questions, you're ahead of most retail traders. Remember, risk control comes before returns. We're here to help you understand the game's rules before you play. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.